Assalamu alaikum. Welcome to Islamic Finance Program. My name is Almir Colan and we are talking today about shares, musharaka and everything around corporation. Now if you remember from our last episode we were discussing about this issue of musharaka, partnership and so on, and we were trying to draw some links between modern corporation and classical musharaka. We discussed a few different things here and there, and then we asked question about the shares.
In the shares, how do each person's shares increase? Eventually what happens in this company?
So how would the share increase? Share would stay the same. Yeah? So like we said, remember in the previous example when we have two partners, each partner will have 20% or 30%. Here each person would have, for example, maybe 1%. Let's say this was 1%. So half of this is 0.5%, yeah? A quarter here is 0.25. Okay? One little dot here is maybe 0.001%. Now let's say that that part always will stay 0.001.
Okay.
You always owe part of that company, part of the pie, you know, part of the pie. You always grow, have part of that pie. Now what is happening in the company as they do business? The pie grows. So therefore your part of the pie grows with it, but the ratio is still the same. You understand? So the ratio is always the same. It's always 1%, 2, or whatever it is you have. But you are growing the pie. Okay? So return like a capital gain.
So basically it will be 1% from 100, 1% from 200,
exactly.
1% from 300.
It will be 1% from the 100 all the time. So for example, what does that mean? Let's say initially this was valued as 100 million, but maybe in the future they do so well, this is now valued as 400 million. So each of these blocks is the same 100 blocks will be now worth 4 million. And remember we said if we divide it in 1 million for $1, now each of these would be now worth, if I divided it in 100 million shares, it would be, shares would be worth $4. Remember we started, we said we could divide it in 100 by million or 100 million shares by each dollar.
Yes.
So the shares would be initially $1, yeah? So $1 on the market. After a couple of years,
as it grow.
So it's now for 4. For example, when Google, I think, listed their shares, I can't remember now, but I think it was something like $100, for example. Okay, $100. Now, how much is Google? Well, I'm not following much, but maybe
billions.
Maybe like 300, for example. I have no idea, no clue. Maybe more, maybe less, but it's a lot more than it was originally. So maybe it's 300 now. Why they increased? Why did this increase?
Because it was doing well.
Revenue from advertising, from whatever they're doing, is people saying, okay, now you are getting, I don't know, you're making 50 million a year, so obviously the company will be worth more than 100 million.
Yes.
If you're making a year 50 million. Yes, it's the same. So Google is making billions. Each piece of the business is generating profit, and usually you evaluate the profit by how much it generates.
Yes.
So you say, now this is bringing so much, I will not sell this much anymore, you know, I will sell it for higher price. It's much more valuable. See, this pen generates so much money, I will charge more. I will not just sell it for any more $1, but 5, 10. So this is how this grows. And this is of course happening, this price is by people, you know, this is what he said, supply and demand. So they go on the market, they sort of buy and sell.
When a person has shares, so the only way he gets back his money is to sell that shares.
Exactly. You are the owner now of the company. So that's what we are saying. So in fact, if we look at this situation, what the shares represent in the company is, what we said, is partial ownership. You are now owning what they call interest in the company. Ownership interest you have, not interest like riba. Ownership of a specific part of a total company. So out of this company you owe part of it. Now question, is it permissible then to own these shares? So this starts trading, I want to get out of this. Is it permissible for me first to own this share, and then if I want to later sell it to someone?
As long as it's an asset, yeah, I can do it.
If it is the asset, if it is something that is real, tangible, you can negotiate the price. Meaning, bargain, give me more, take less, or whatever. This is what market is doing. Like when you go in the market where these things are done, any market like, I don't know which one you have here in Egypt, what's called stock exchange
Stock
here?
exchange.
Egyptian stock exchange something. So when you go there, people, what do we buy and sell on the market?
Shares.
That's why we call it share market. Because market is a place where people buy and sell. So in the market where you sell food, it's called food market. Place where you buy and sell shares is called share market. If you have any other derivative market, it's derivative. It's, you know, so the name of the market will have its function in the title. So in the share market you buy and sell ownership of the company. Ownership in the company. So they do it through computers. And usually what you would have on one side people saying something like they give an offer. Okay? They give an offer how much they want to sell. So they say, this business I will sell my shares. Somebody says I will sell my shares. So it's now last bought share. So on this side we will have person saying I have 100 shares that I will sell each $4.5. Okay, so how much is the share price now reached in our company? Each share reached $4 here, we say. It started with one, over time it got better, and it's now sort of $4. What mean this $4? How do we know it's $4?
Because of working out your percentage of your share.
How do we know how much something costs?
Because of the profit that we've made.
Sure, you can have a profit, but that's fine. But how do I know? How do we agree on what this number 4 is?
According to the market?
So what does that mean according to the market? How would that be according to the market? People come and then do what? So how does supply and demand determine this rate?
If it's increasing.
Statistics? This is the last price at which shares were bought or sold. Okay? So the last time anybody bought or sold this share will determine the price for the rest of the shares on the market. So this is the last one. So now on one side we will have people, okay, so they say 4. Well, I have 100 shares, I'm not going to sell them at 4. My thinking is it's worth more. So I have my 100, I'm ready to sell. You give offer, I'm ready to sell at 4.5. Okay, some other guy, maybe he's got also 100, he says I'm ready to sell it at 4.4. Another person says I'm ready, I have 1,000 and I'm ready to sell it at 4.3. Another one say I have 50, I'm ready to sell them at 4.2, and so on. Another one says I have 5,000 and I'm ready to sell them at 3.9. Person then go here, 10,000, I'm ready to sell them 3.8, and so on. So this goes down on price. So you have price here, let's say the highest. So you have a price and you have how much here. Now on the other side, what do we have? What do we have on the other side? We have opposite. Yeah? Opposite here is because now here person, let me actually put it here next to these guys, okay? I'll just delete this one here just to make it easy for us to follow what's going on. It's still same company, guys, okay? So just imagine this, the rest of it here. So now on this other side somebody is saying, you know what, I might want to buy some shares in this company. So what I'm gonna do, I wish I could buy 100 at $3. Well, you say, inshallah, you buy them, but you never know. So he's hoping, he's wishing, you know, but of course it's very low now for the market. Now another guy says, I wish I could buy 500 at, you know, 3.5. You have somebody who will say I wish I could buy 50 at, I don't know, at what? 3.9, yeah? So you go like that, there is somebody who wants to buy 1,000 at 4, okay? And then there is somebody who wants to buy another 50 at 4.2, and another one wants to buy 500 at 4.3, whatever. Why do we write all of this stuff? Why do we write? So there is some offer here, people expressing interest. Is there a match here anywhere? Is there a match?
No.
This guy can't find buyer for this. He can't find it. Nobody here is willing to buy that. People see this, nobody want to buy it. Either it's too many or too little. Maybe if he had more or less, might be. And so on, similar here. Although it's below price maybe, but nobody wants that many. However, as we move along, and the same here, nobody want to sell anyone for 3, okay? Same is here for 3.5. And also nobody want to sell even for 4.3 or 500. So there is no match. However, there is match here. Somebody want to sell at 50 at 4.2, while another person want to match that. Want to buy 50 at 4.2.
So I'll take it as an average?
No. Exactly. I'm buying. There is no average. I will buy this many at this price.
This price.
Because what does this mean? How much this is going to cost? It will be 50 times 4.2. How much is that?
10,000.
No, it's a bit, what is that?
About 200.
A bit more over 200 something.
About 220.
Something.
Yeah.
220.
All right. So that's what it is. 200 and something. That's about just over 200 bucks. So now I have specific amount. I don't want to adjust anything. So at this particular moment, after they offer this person accepts. Then in the market they give money and you get the shares. You become the owner. We transact. Okay?
Okay.
When this takes place, what will be the price of the shares now on the market? The price will change. It will be 4.2 now.
Because you bought it for that price.
That's what it's going. That's what someone is willing to pay. In the same time, maybe there will be somebody who buys here, says, you know what, I want 5,000 at 3.9. So this guy will now find a buyer. Okay, if they go ahead with that, the new price, 3.9. And that's why, as you buy and sell, you see a graph will go a little bit like this.
So this is always
Always buying and selling, the price goes up and down, and this is what is supply and demand.
So could the price go down within seconds?
In a second, and it goes even in 4 seconds. Inshallah, after the break, we will see how this affects our daily life. Welcome back. We are discussing a little company that we created and the share market and what are the implications of each. So before the break we were discussing how this buying and selling of the shares, individual pieces here, is actually creating this little fluctuation in the price. Now we said 4, 3.9, sometimes these can be much more less than that, maybe it's a 4.01 or 2 or 3, so the prices are more. However, it does go up and down in the day, in a second. Okay, does that make sense? How this supply and demand in the sense of who is putting these shares on the market and how much they are willing and how much people are buying. Now you can see how much this depends on volatility, meaning the price movement, how much people are buying, on some speculations. Okay, if people don't trust the company is doing well, what's going to happen here?
Everything.
People will start dumping their shares. They want to get rid of them quickly, so they will offer them at cheaper price. And these people will get them at cheaper price, which means the share will be reflected here, yes? So immediately we'll see. So more that goes down quicker, especially if it is fueled by some speculations, we will see that the price will go down. So in the case of Facebook, for example, the shares were going down after IPO because there was a rumor they can't make money out of mobile sales of advertisements through the mobile technology, and that the revenue is not that much and so on. So it was driving it down. Okay? So this is where we see this particular speculation.
Does the stability of any country affect that? I mean, people are going to say, oh, this country is going to be...
Sure, it does. It affects everything in the country, because you see, when we talk about, for example, any country, they would have performance that day. For example, Dow Jones, okay? That is like an index. It's not a whole thing, every single, but for example, certain amount of the top companies, the best one in the country, like in Australia they call ordinaries. So it is not every single company, but let's say top 100 companies, what they call like a blue chip and mix of different sectors and all. Why would they group them all together? They would group them to know the health of the country. So they would group 100 key companies that are a backbone of the economy of the country. And they would say, for example, these 100, they would sort of do average how much their value is, and they will assign certain number to this. Like for example 10,000. You know, just doesn't mean anything, just number, okay, points. So this 10,000 would then represent starting point. So if tomorrow you wake up and Dow is 9,000, or state of US, for example,
It's dropping.
there is some confidence problem. So in GFC, or this is going down. So if I'm an investor looking to invest in US, I have some doubt. So will that real people getting real money, businesses doing?
No.
It will.
Yes, because
Normally having that access to the money, it will be now restricted. Or if I want to invest here, what is this number telling me about the country?
that it's dropping. It's unstable.
In terms of risk and return, remember?
Yes.
What is it, risk? Is it more riskier?
It's
More
increasing.
risky.
Yeah,
More
more
risky.
riskier. So if the risk is more, what do you think investors will want in return for more riskier investment?
They need more protection or security.
They will take their
therefore-
money.
And
They will
therefore,
take their money back.
they will
sell their share.
it's either sell it or start removing the share.
Or they will demand more return. So return will go up. So now we talk about, for example, conventional finance. When this, if they could access, if the company or a country or something like that, if they could access money at, let's say, 5%, this is conventional, let's say 5%, this is for given risk. If like Greece now, if it's become riskier, will they pay their loans? Will they default? Will they be in the euro? Will they get out of the euro? Will they go back to drachma, their previous currency? Country is now like almost, they call it junk status. It's not investable at all. And the rating goes down, everything, people taking money out. So this is reflected in the confidence. And if people want to buy government bonds, meaning to give money to the government, you know how much they demand? Maybe 15 to 20%.
That's too much.
True, but that's how it is, because it's so risky. Remember, risk and return, this is how they think. Now this is not Sharia compliant, these bonds and stuff, but I'm saying, what is the effect on the country? Even if I'm, as a Muslim, looking at the country and it's not going well, you know, I might wanna, for example, in Musharaka, increase my share in the profit to compensate me for some risk. You understand? So I want to protect myself. So if they default, I will have, so risk and return will determine expectation from the people. I will not expect the same here. So this will affect the company, this will affect the business, the country, everybody else. So that's why we have share market, these people look constantly. Now, originally Dow was not out, or any other index, was not meant for these speculative purposes. Normally people who invented it, they would look at this maybe once a month, maybe once a week, just to know. Today people look at this in a second by second. Why? Because the whole of this buying and selling is completely automatic, and we said done through these computers. So these computers, they would analyze this. They would have these high frequency trading computers, they would analyze this data. In fact, I have a colleague, they manage money for other people, and next to him there is another company, and they move there because in that building it's directly connected to, I think, internet, backbone of the internet or something like that. Directly connects to the internet. So what it does, it's maybe save them a millisecond or two when they execute these trades.
Oh,
More faster than those that are working faster than a second.
You see? So it's millisecond. Say, if he is maybe in the suburb, it's maybe 1 millisecond slower. Why do you need that? Why would you need milliseconds?
because it goes faster than...
It shows fear.
It wants to execute hundreds of thousands of these operations in a second and trades. So it wants to figure out who is buying what, how they are doing that. And idea is not anymore to look what this business, you remember we said what the business is doing. Forget what the business is doing. We want to know what these traders are doing so we can, through these computer algorithms, figure out how to benefit from it. So they are trying to outsmart. But you know what the problem is? So you put one computer with their algorithm there. You think that's going to stop? There will be another guy putting his computer there. There will be another one, another one. So now maybe 50, 60 more of these trades are done through these computers. Now the problem is there that we don't know who is buying what. Who is buying what, how they are disposing of these things. And all of the best and the brightest students, engineers, mathematicians, they want to study to work for a bank. They don't want to be engineers, maybe help in the develop the farming. We have the problem how to feed humanity, how to solve the cancer, malaria, you know, the help the world, solar, renewable energy. No, no, no. We get these best guys with the highest skill to learn how to do these things better. Make nothing and make $100 million a year in profits. So they absolutely have no value in the real life, but we take the talent to create weapons of mass destruction here. Financial weapon of mass destruction, okay? So that's what we kind of have for us today. Any quick question? Does that make sense?
Yeah,
Maybe inshallah next time we might continue on Mudaraba and other partnership arrangements. But for now, that is all. Thank you for joining us, and Assalamu alaikum.